Liquidity versus interest rate risk, balancing the ALM equation. Introduction. In the dynamic world of finance, asset-liability management, or ALM, plays a critical role in maintaining the health of financial institutions. Balancing liquidity risk and interest rate risk is at the heart of effective ALM. Today, we will explore these two essential components and how they influence each other. Understanding liquidity risk. Liquidity risk refers to the possibility that an institution might not be able to meet its short-term financial obligations due to an imbalance between cash inflows and outflows. It's vital for institutions to maintain sufficient liquidity to cover unexpected demands for cash. Key factors influencing liquidity. Market conditions. Economic downturns can tighten credit, making it harder to sell assets quickly without incurring a loss. Regulatory requirements. Banks must hold a minimum amount of liquid assets to ensure they can survive periods of financial stress. Operational efficiency. The internal systems and processes must be efficient to manage cash flows diligently. Understanding interest rate risk. Interest rate risk, on the other hand, arises from fluctuations in market interest rates that can affect an institution's financial condition. When interest rates rise, the value of fixed income assets typically falls, potentially leading to significant losses. The types of interest rate risk. Repricing risk occurs when assets and liabilities reprice at different times. Yield curve risk, the risk associated with unexpected shifts in the yield curve. Basis risk, when related interest rates move in different directions. The dilemma, balancing liquidity and interest rate risk. Achieving the right balance between liquidity and interest rate risk is essential but challenging. Excessive liquidity might mean lower returns, while insufficient liquidity can lead to solvency issues, especially during financial strain. Strategies for balancing risks. Diversifying funding sources. Utilize a mixture of short-term and long-term funding sources. This way, you can support liquidity while mitigating interest rate exposure. Regular stress testing. Performing regular liquidity stress tests can help identify vulnerabilities and prepare for potential funding shortfalls. Interest rate derivatives. Utilizing products like interest rate swaps can help hedge against unwanted fluctuations in interest rates while still maintaining liquidity. The role of ALM models. Advanced ALM models can simulate different scenarios, allowing institutions to assess the impact of various liquidity and interest rate strategies. These models help in crafting a robust risk management framework that ensures both adequate liquidity and yield optimization. Key components of ALM models. Cash flow projections. Forecasting cash flows over various time horizons to identify periods of potential liquidity strain. Scenario analysis. Assessing how different economic environments impact both liquidity and interest rates. Performance metrics. Establishing key performance indicators for measuring the effectiveness of your liquidity and interest rate strategies. Conclusion. The interplay between liquidity risk and interest rate risk underscores the importance of a well-designed ALM framework. By understanding these risks and implementing effective strategies, institutions can achieve a delicate balance that ensures both operational resilience and financial performance. In summary, focus on diversifying funding sources, conducting stress testing, and utilizing interest rate derivatives. The goal is to maintain liquidity while managing the potential impact of interest rate movements. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.